they can't handle billions in losses. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, if you thought the subprime auto delinquency wave was going to be a big problem for the banks, wait till you see the next problem they're facing, because this one's even bigger. Plus, many people are pinning their hopes on a soft landing. We got some new evidence to show that maybe that's not happening. And in yesterday's show, we also talked about the triggering mechanism that was sending the economy into a downward spiral. Well, now we've got some data that says that may be just a couple months away. Let's over to Wall Street Journal, where we picked today's story up with a headline: office landlord defaults are escalating as lenders brace for more distress. And this is an issue that seemed almost obvious. Before the pandemic, virtually everybody worked out of an office. People were commuting, they were going to work. And then during the pandemic, of course, we found a lot of people's jobs shifted to work from home. And post-pandemic, now we're seeing many people demand either to keep working from home or have a hybrid work schedule. And the natural assumption then would be we don't need all this office space. And yet you may recall during the pandemic, the banks were doing a mountain of commercial loans. They were refining these properties, they were extending loans to them, and now all of a sudden demand isn't there. Buildings are going empty. And what do you think is going to happen next? Well, you got it. Delinquencies will soon lead to defaults. The giant investment manager Brookfield Asset Manager recently defaulted on a total of over $750 million in debt for a pair of 52-story towers in Los Angeles. Real estate firm RXR is in talks with creditors to restructure debt on 61 Broadway, a 34-story tower in Manhattan. Handing over the building to the lender is among options under consideration. Now, this almost seems frightening to some level, as these companies are saying, hey, you know what? We can't rent this out. We can't make money. Here, you have it back. And these aren't like cars where, of course, the losses are relatively small. These are massive office buildings where you don't have people that want to rent them, and you've got massive mortgages on them. And of course, that means prices are going to come down, loans are going to go into default, and the banks are going to be on the hook for billions. 5 to 10 office towers each month join the list of properties at risk of defaulting because of low occupancy, expiring leases, or maturing debt that would have to be refinanced at a higher rate. So again, there's no demand here. What you're seeing, the demand is for people saying, I don't want these buildings anymore. You can have them, bank. And boy, you can better believe the banks are not going to want them back, and certainly not that many. Concerns over the health of the office building industry have mounted through the pandemic. The weak return to office rate has led soaring vacancy levels in many cities. Last year's spike in interest rates increased the cost of buying and refinancing properties and squeezed the values, which are likely now to head much lower. And for more landlords, losing buildings to creditors after a default would be painful, but not devastating. Again, I want you to understand, they're saying here, look, this may not be a big deal. And you might think that, hey, if I defaulted on my car loan or my home loan, boy, that would have a major impact on my ability to borrow in years to come. Why wouldn't these people be worried about borrowing or defaulting on a loan that could be worth hundreds of millions of dollars or even more? Well, because the way they've got that structured. Many investors structure building as separate financial entities. If they default on the debt, creditors can foreclose on the building, which means they get the building back but have no recourse against the rest of the company. The pain from foreclosures is likely to ripple through the financial system. About, get this, $1.2 trillion of debt was backed by office buildings at the end of the third quarter last year, and now you can easily see why the banks would be facing billions in losses. And you think about how fast, again, we talk about turning a car over. If a bank gets a car back, at least maybe there's some value that they could resell the car and take a loss. But what do you do about a building? Because a building needs ongoing maintenance. You can't just sit it there for, say, 5 years and do nothing with it and hope someone comes along at some point and rents it out. You've got to maintain it. You've got to keep it up. You've got electricity. You've got utilities. You've got all kinds of things that have to be done to keep that there. The banks are in no position to take buildings back, or even a whole lot of them at that matter. And this could be this thing that sends the banking industry to its knees. Now, many people have asked, hey, how do we know that these machines are positioning to the downside? Again, I point out on today's report, there were 6 left on the coupon if you wanted this before it goes to $30. Here you can see selling down the S&P 500. You wonder why the market's moving down. Why did the bond market sell off? The report tells you every day how the machines are looking at it, plus the different ETFs. Again, 6 left on that coupon code, because now I want to talk about this whole soft landing issue as we get into the next part of our story and our show today. Is a lot of people are hoping for a soft landing. Now, what does that actually mean in terms of an economy? It means, well, it slows down to a certain level. You get layoffs and you get other things that we start to see in the data, just a slowdown in the general data, and then it should plateau and start to steadily grow there. But what if you get to the plateau and then it starts to head down a little bit further? Well, then that tells you the soft landing is going into a major recession. And now we're getting some preliminary data that suggests perhaps this soft landing is about to turn the other way. And here we go with manufacturing. We're going to start with Australia manufacturing PMI. Now remember, we're going to go fairly quickly through some of these numbers. 50 means unchanged from the month before. So what we would want to see if we're having a soft landing is these numbers start to move above 50. Well, 50.1 means still unchanged for the manufacturing sector in Australia. But now let's get into Europe. Look at the French manufacturing sector. Again, these are all preliminary data from the first part of the month. What do we see here? 50 to 47.9. So now it's contracting a little bit. How we move it down into Germany, the manufacturing sector, 47 to 46.5, further contraction. How about the broad Eurozone? Was at 48.8, contracting the month before. Preliminary data shows it's still contracting. How about Great Britain? We look at the manufacturing PMI. It was a little bit better, was at 47, so it was contracting, now moved up to 49.2, a still indication that we're seeing contraction here. So this is what I want to suggest to you is, unless these numbers start turning around and go positive, this soft landing is going to turn into a hard crash. And let's head over to the US data now and see what it has to say. And sure enough, what do we see? Manufacturing PMI 46.9, contracting last month. This month, what do we see? 47.8 on the preliminary data, again showing further contraction. And you start to do the math here real quick, that the manufacturing sector continues to contract. And the reason, if you're wondering, why are we looking at the services data? Because it always lags and follows the manufacturing data. Whichever direction manufacturing goes, services follows with a lag. But at some point, the manufacturing sector is going to start laying people off if we don't see a turnaround. Now let's look at what the analysts had to say of this report, because even they don't seem overly optimistic. February has seen a welcome steady of business activity after 7 months of decline, despite headwinds from higher interest rates and cost of living squeeze. However, there are some caveats to the good news. The upturn is being driven by the services sector. Again, I want to point out that this lags the manufacturing sector, which in part reflects unseasonably warm weather. And although the manufacturing survey data shows signs of improvement, the sector remains in contraction and focused on inventory reduction, which of course we note that inventory is a massive problem in the economy right now. But let's continue on. Furthermore, the improved supply situation has taken price pressures out of manufacturing supply chains, suggesting inflation is coming down. By potentially stoking concerns over a wage price spiral, accelerating service sector price growth will add to calls for higher interest rates. So here you see that this report, the analysts are saying, look, this is all about the services sector. The reality, it's about the manufacturing sector. If there isn't demand there, the economy is going to continue to head lower. And now we're getting some signs out of the retail sector. We just got some first reports today that suggest that even they too are on the cusp of layoffs. And wait till you see the chart that I've got for you at the end of the show here. But what we're going to do is let's take a look at these retailers, because if they don't have demand, the manufacturers don't have demand, and you're going to see layoffs across both of them coming soon. Walmart outlook disappointing, signaling caution on shoppers as the company predicts a second straight drop in annual earnings. At U.S. Walmart stores, comparable sales, excluding food, will gain no more than 2.5% during the current fiscal year, which is early 2024. That trails a 3.1% average of analysts. Now again, 2.4% in terms of sales. Well, where is that? well below inflation. So here you can see Walmart saying, hey, our sales are down. We're not growing against inflation. Now, this percentage is up, but relative inflation is down. That's a key sign that consumers are in trouble. Let's head over to Home Depot. Well, we see the same thing. Home Depot forecasts earnings drop this year as Home Depot has guided for flat sales growth in each of the last 2 years, but still churned out sales growth as higher prices, get this, offset decline in customer visits. Last year's sales rose 4.1%, again, behind where the inflation rate is. So again, you're seeing demand here go down. You're going to see eventually they don't need as many employees. And when that happens, all bets for the economy and then the banks are off. This is the seventh straight consecutive quarter in which fewer higher dollar transactions lifted Home Depot's top line, with total transactions, get this, falling 6%, while those tickets were 5.8% higher on average. Again, we're seeing the signs of inflation here, but how does this all translate to the labor market, which is the linchpin of the economy? When the labor market goes, there's going to be nothing standing in the way from these banks taking billions in losses. There's going to be nothing standing in the way from them on the auto loan crisis happening. Credit cards are going to go default. And here is, let's take a look at this chart here. Retail sales in blue against a 4-week moving average of initial claims. These look nearly mirror of each other as retail sales growth trends lower. What happens? Initial claims from unemployment had higher. Again, retail sales trending down, initial claims rising. And we see that right now, retail sales coming down. My friends, I want to tell you, it's only now a matter of time before retailers start to announce that they're laying off. We'll see the manufacturing sector laying off. And at that point, it doesn't matter what the Fed does. The economy is headed into a recession. And the banks, I think, now due to this commercial real estate issue, are in big trouble. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.